We believe JUP holds great value as a symbol of DeFi 2.0. We reject the persistent utility myth that utility grows value and believe that this myth is the greatest distraction and value destroyer ever. Please do not engage with Jupiter if the utility myth is important to you. We will not engage in this discussion. Welcome to Crypto with Cami, where we go through all the main headlines in crypto and DeFi in the past week in 30 minutes or less. This is the show for the week starting January 29th. So this was another Solana heavy week. One of the main headlines was Jupiter's $700 million airdrop. SocialFi DApp Farcaster also made waves, as did the liquid restaking and staking sector, which is heating up. So let's start with the JUP airdrop. So I'll give you the main overview and then my hot take. So Jupiter is a decentralized exchange aggregator based on the Solana blockchain. This week, it had a massive airdrop where it was distributing about 700 million worth of its JUP or JUP token. It was the fourth largest airdrop ever, taking token prices on the day of the airdrop as the measuring stick. So the Jupiter tokenomics are structured a bit differently from what we've seen recently in other DeFi protocols. To run by the main numbers, Jupiter's JUP token will have a total supply of 10 billion. The 10 billion total tokens are split 50-50 between the team and the community. So this on its own is pretty unusual just looking at that number. So this week, of that 10 billion, they issued 1.35 billion. So there was the 1 billion airdrop from the 5 billion allocated to the community. And of the 350 million left, 250 million went to a launch pad where people were able to buy JUP tokens directly from the team. Then another 50 million went to loans to market makers on CEXes, and 50 million were allocated for liquidity provision. The 4 billion remaining JUP tokens on the community side will be distributed over 4 separate other airdrops, which will happen on January 31st of each year. So if you missed this airdrop, you're still in luck for, the next airdrops coming up, but you'll have to wait a year. Of the 5 billion of JUP tokens distributed to the Jupiter team, 20% of those tokens will be given to the current team. So this is important to note, because when you first hear 50% of tokens will go to the team, it sounds very high. In general, team token allocations range between 15 to 30%. 50% seemed a bit high, but in reality, 20% of total tokens will go to the current team. And those tokens won't begin vesting until after 2 years. And then 20% of that 50% or 5 billion total tokens for team allocation will go into a strategic reserve for future team members. And then there's the remaining 10% will be used for liquidity provision. So the 50% team token allocations, 20% current team, 20% future team, 10% future allocation. Okay, so there was a big controversy about the airdrop, with the focus being on the 250 million tokens that the team was selling through its launchpad pool. So the pool is open until February 6th, and anyone is able to trade USDC for JUP tokens, and the price is set along a curve. Right now, the team has raised about 130 million, and that's including USDC deposits plus a fee for using the launchpad pool. So people were a bit upset about this. We have some comments here from Lord Ash Drake, for example, said, "Bro, wait a minute. So we bought 200 million JUP tokens with USDC, and the dev said he plans to remove the liquidity in a week. Does this mean we literally paid the dev 9 figures for free tokens? Was this sort of a hidden type of fundraising or ICO? Adam Cochran also weighed in. He said, gave 50% of tokens to themselves. It was not their first token, used their own platform, which also paid self, pulled liquidity from the pool in cash, gave cut to the dev team. So cash out 30 million day one with no lockup and still own 50%. Shitty antics, throwing away reputation. So yeah, there was a bit of controversy over the airdrop. For context, again, like this is the fourth largest airdrop ever. It's the biggest DEX on Solana. That's why it's worth kind of going over in more detail what's happening. So to be honest, I'm not so scandalized as others by this mechanism. For context, 250 million is just 18% of the 1.35 tokens that were issued this week, and just 2.5% of the total supply of 10 billion. The Jupiter founder, who goes by Meow, curiously, has said the team won't sell any of the tokens raised in this launchpad pool, and that anything and that all the funds will go into their treasury. So initially, the 50-50 split sounded like a lot, but looking at the breakdown more closely, only 20% goes to the current team, in line with other token distributions. There's also a 2-year vesting period. So the team can only start selling tokens after 2 years. So it doesn't look so egregious to me. What does look like a bit much, though, is JUP's valuation. So JUP immediately became the 6th largest decentralized exchange by market cap on the day of the airdrop, according to CoinGecko. So market cap shot to as high as over 900 million. It's now at over 800 million, right in line with DYDX's market cap. For comparison, DYDX does 24 billion in monthly volume, and Jupiter does 16 billion, so about half. So it's not an apples to apples comparison for sure. Jupiter is a DEX aggregator, DYDX is a derivatives exchange, but still, I mean, DYDX has twice as much volume as Jupiter, and they have the same market cap. What's more surprising is Jupiter's fully diluted value, which is the value of JUP if all of the tokens 10 billion supply were released today at today's prices. So if that happened, FDV would be 6.3 billion. That's higher than Uniswap's 6.2 billion. So as you probably know, Uniswap is the largest DEX by volume. It trades about 40 billion monthly versus JUP's 16 billion. So again, it's a bit high. JUP's valuation right now, it's at same market cap as DYDX, higher FDV than Uniswap. So some could argue that Uni has horrible tokenomics, that Uni isn't useful for anything. But Meow, the Jupiter founder, has stated in no uncertain terms that JUP is absolutely useless. He called the utility a myth. So this is a quote from one of his posts. He said, "We believe JUP holds great value as a symbol of DeFi 2.0. We reject the persistent utility myth," that's his quote, "for tokens that utility grows value, and believe that this myth is the greatest distraction and value destroyer ever, despite it persisting in crypto Twitter narratives. We refuse as such, and especially since utility is not part of the Genesis narrative. Please do not engage with Jupiter if the utility myth is important to you. We will not engage in this discussion." So maybe there's an argument to be made here that investors are giving a premium to the fact that Jupiter is an aggregator and that users will interact with DeFi through aggregators instead of directly to each DEX. Maybe that explains the higher valuation. Maybe the premium is because Jupiter has the highest DEX volume on Solana. And the bet here is that Solana will end up beating Ethereum as the main liquidity hub. And here's a Dune dashboard, which shows the share of Jupiter in Solana DEX volume, so it accounts for about 60% of Solana DEX volume. The same dashboard shows how USDC volume in Solana has been creeping up, and it's almost surpassing Ethereum. So you could make that bet. But to be honest, I think the main factor weighing in JUP's valuation right now is extreme hype. So, something to consider when you're aping. As we're talking about Solana, I want to give a shout out to this great report by hedge fund and Defiant friend RE7 Capital. They published this awesome report on our website, so go check it out. Now on to the other headlines. There's lots of liquidity staking news. Let's start with Stride. So Stride is the leading liquidity staking protocol in the Cosmos ecosystem, and it has added support for Celestia. The project has allocated 5 million Stride tokens worth about $18 million at the time of reporting. And it will distribute an airdrop for early adopters of staked TIA tokens. So 3 million Stride will be distributed in the next 60 days. Next up is Puffer Finance, another liquid restaking protocol launching recently. Pretty impressive. It opened its doors to depositors on February 1st, launching a quest and vampire attack seeking to reward users in exchange for converting a Lido staked ETH token for its liquid restaking token, Puff ETH. So the campaign was very successful, and it was able to raise or attract almost $200 million in the first day of launch. So yeah, this Puffer Finance new liquid restaking protocol are really making waves. We've had a few vampire attacks, protocols exchanging incentives for people switching over from another protocol. And this is what Puffer is doing, and doing so very successfully. So something to keep an eye out on. Then next liquid restaking news is Vector Reserve. So this is an Ethereum-based protocol. It launched VETH, a novel liquidity position derivative, LPD. Hard to keep track with all of these acronyms for tokens, LSTs. Now there's liquidity position derivative, which this LPD token is backed by a basket of yield-bearing tokens. So VETH can be minted against Lido staked ETH, Renzo's EC ETH, EtherFi's EETH, Kepler DAO's RS ETH, and regular wrapped ETH. And since launching this week, it has grown to a market cap of 5.2 million. It's offering very high yield by aggregating all of these liquid staking tokens in one. So interesting to check out. Next, liquid restaking news. I told you guys this was heavy LST week. Swell announced the launch of RSW ETH, a liquid restaking token. The token allows users to earn Ethereum staking rewards and native restaking yield from EigenLayer without locking up their liquidity, meaning users can also use tokens in other DeFi protocols. Token holders can also earn EigenLayer's restake points along with pearls, which is incentives of Swell. So pearls are like points which represent a future claim on Swell's forthcoming Swell token. And Final liquid restaking news, DYDX chain launched a liquid staking token for its DYDX token. So this means that you can stake DYDX on the DYDX chain. That's a native chain of the Cosmos ecosystem. And you get a token in return, which gives you liquidity against your staked DYDX. So that's all for liquid restaking and staking news this week. Obviously, a huge growing sector in DeFi. Everyone wants to extract as much yield and as much liquidity from their trading activity. And so liquid staking and restaking is a way to do this. So that explains the popularity of all of these tokens and all of these protocols. Another big headline of this week is SocialFi DApp Farcaster. Activity was spiking this week. I opened my first Farcaster account. If you guys want to find me, not very active yet, but I have planted my stake there. Cami Russo is my account. So Farcaster is an optimism-based platform. It registered more than 10,000 daily active users over the start of the week, and it's been on a consistent uptrend. If you look at their Dune dashboard, charts look pretty crazy. Everything's spiking, and they surpassed 70,000 total users. And so driving all this activity is this really cool feature called frames. And frames allow developers to embed different experiences in posts. So Farcaster, imagine it's like pretty similar to Twitter. So you post casts, which are tweets, are like tweets. And the difference is that with frames, you can directly embed in these casts different experiences, whether it be games, instant checkout, NFT minting, etc. It's a flexible tool that allows people to build whatever. One of the most popular tools I saw was instant checkout for Girl Scout cookies. So really just doesn't have to be Web3 related. People are building whatever, which is super interesting. I was mentioning that it would be great to have something like a Squarespace for frames, because right now you do have to be pretty technical to build this. Now, next headline is Manta, and you'd be excused if you've never heard of this, but because it just launched, but it has rocketed to become the third largest layer 2 with $2.7 billion locked in TVL. Pretty interesting. Manta, it's an Ethereum layer 2, but it gets its security from Celestia. It gets its state availability for Celestia. So pretty interesting. And yeah, it launched last month, January 18th. But it's already the third largest layer 2. It's worth noting, though, that about half of Manta TVL is in its own token. So, take that with a grain of salt. Still, worth keeping tabs on this new layer 2. In real-world asset news, Robert Leshner's new asset management firm, Superstate, launched its first fund. It's a tokenized fund which holds treasuries. And next, I will run through the last few headlines we're highlighting. Polygon Labs is cutting 60 team members. The team is now 220 people. And they're spinning off 2 units, Polygon Ventures and Polygon ID, in a major restructuring. They wanted to make it clear it's not about cost cutting, and the team the salaries of the team will be increased. Celsius begins asset distribution to customers and a court-approved FTX's repayment plan. So these CeFi users and customers will finally get a bit of closure from the failures of these companies. Okay, next up is Ethereum's Dencun upgrade went live on the Sepolia testnet without a hitch. A reminder that this upgrade to Ethereum will allow for layer 2 scaling solutions to lower fees. That means cheaper transactions on Ethereum L2s. ETH rallied this week on speculation that Ethereum ETF would be approved. On more ETF news, and good news for Bitcoin is that Grayscale's ETF outflows slowed this week, pushing Bitcoin prices up. And finishing with more good news, there was a DApp Radar report that showed that DApp users surged to their highest level since 2022 at 5.3 million in January. So that's it for this week. Tons going on, lots of craziness, drama, airdrops, all the things we love about crypto. So join me next week for all the biggest and latest headlines in DeFi and crypto. Like, subscribe, recommend the Defiant, and yeah, see you next week.